Purchasing a new construction home can be a great real estate investment. However, finding a new construction home that cash flows right off the bat is becoming nearly impossible in today's market. Or is it? Stay tuned to find out, as I will be going through my latest real estate investment purchase. Welcome back, guys. It's Tom here from Off Mortgages. Thanks again for tuning in, and as mentioned, today we're going to be running some numbers and going through a property that I recently purchased in Alberta. This property was purchased by myself and a buddy of mine. We went in together, and I'm really excited to show you guys this. As mentioned in the start, finding new construction homes and having them cash flow right off the bat is very, very hard, especially in the Ontario market. However, this new construction home that I purchased is actually out in Alberta, and I'll show you why I purchased out there. But before we get into her, please feel free to like the video down below and hit subscribe. Hit that notification bell as well. That way you won't miss out on the next videos. Purchasing new construction homes can be one of the best real estate investments and one of the most hands-off strategies that you can do. It's also one of the best appreciating assets that you can purchase. However, having them cash flow is becoming harder and harder in Ontario. Unless you have a significant down payment to purchase the place, that cash flow is not happening anywhere in Ontario. And what do I mean by cash flow? Ideally, you want to be left with a positive cash flow. So say you take the monthly expenses from your property, let's say that's $2,000, and you're subtracting that by $2,200 rental payment. Now that's going to be leaving you with a $200 positive cash flow. But here in Ontario, it's becoming almost non-existent to have that positive cash flow, and that's due to the rising prices in real estate. So today I'm going to run you through all the numbers with this property that I purchased in Alberta, and we're going to determine whether we're going to be cash flowing positive or cash flowing negative on this property. Okay, so I'm going to take you through my full budget analysis for the property. This spreadsheet was actually provided by Andrew Hines. He is a real estate investor here in Ontario. He has an awesome podcast. I recommend anyone that is new to real estate investing, definitely check it out. I'll also link the website where I downloaded this budget analysis from, so you can go ahead and download it for yourself. One quick note to keep in mind, this property that I bought in Alberta, it's actually in Calgary, and the builder essentially sold it as their incentive for buyers. They really wanted to have real estate investors come and buy these properties. And what they had for incentives was, for the first 3 years, they pay you the rent, and they also have property management on the property. So that's really what enticed me to going this route, because it's very hands-off. They essentially guarantee that they're going to be paying you the $1,800 of rent, regardless if it is vacant or not for 1 or 2 months, or however many months it is vacant for. They're still paying you that $1,800. So you don't have to worry about chasing down a tenant to pay you, because they're taking care of all that. So that's why I really like this. I mean, realistically, you can probably get $2,000 for the rental payment for this property if you did it yourself, which you do have the option of doing. However, I like being completely hands-off, so I'm going to let them take care of everything, and even if it means my cash flow is going to be a bit less. So let's start at the top here. As I mentioned, the total monthly rent is $1,800 monthly, and that's guaranteed for the first 3 years. At the end of the 3 years, I can essentially opt out of the property management that they have there, and I can do it myself and hire another property manager and rent it out for more, or I can continue with their service. So annually, that gross income turns out to be $21,600. Vacancy, usually you account for 3 or 4% vacancy, just in case you do have some months where you don't have tenants paying the rent. However, as mentioned, this property is not going to have any vacancy, because it's paid to me regardless, which is nice. So that's why it's 0%. The gross income is $21,600 still. Now let's dive into the operating expenses. Starting with taxes, that's going to be $1,560 for the year. Insurance is $1,504. Maintenance, so this is the maintenance fees that come with the townhouse, $1,663 annually. The management, so this would be a property management cost Of course, it is optional depending if you were to take care of all the property management yourself or if you hired a property management company. In this case, I do have a property management company that is operating it for me, but like I said, I don't pay any of it because it's included with the purchase price and the rent that I'm getting. So that's why it's 0% there. Lawn cutting, I don't have that as well, so that's 0%. And just for miscellaneous, I always like to account for the unexpected costs. So I put in 1% here, so $216 annually. That brings us to total operating expenses of $4,943. Now the net operating income, you're essentially subtracting this amount from this here, and that's what we're coming up with. Now let's dive into the purchase price here. We purchased it for $349,900. Cap rate, I'm not going to go into detail. Essentially, you don't really need to worry about that for this purchase because it is a new construction. Cap rate, I'm not really going to go into too much detail. That's a bit more advanced, and that's for a later future video, but it's not really too important for this property here. Same with the debt coverage ratio. Let's go into the mortgage details. So we're going to be getting an LTV of 80%. Mortgage amount is going to end up being $279,920. Amortization, we want this spread out to the maximum to keep those monthly payments down as much as possible. So that's why we have a 30-year. Interest rate, right now we can get a 1.5 variable on this property, but I did put in 2% just in case they do rise by the time we get the property in September of 2022. So I always like to account for a bit more there. So your monthly payment's going to end up being $1,033, which gives us a total of $12,402 annually. So that brings us to a net annual cash flow of $4,255, which in turn brings us a monthly cash flow of $354.59. So there you go, guys. We are cash flowing with this property, which is awesome. You don't see that, especially here in Ontario. That's why I really liked this this investment. Also, a couple of cool things with Calgary is, I mean, the market isn't like Ontario. It actually has been declining over the past years, but I expect that to go up over the next 10 to 15 years due to the fact that oil prices are rising. So moving down to more of the mortgage breakdown here. So this is kind of like a projected 5-year forecast of how much the mortgage is going to be paid down. So after 5 years, we're going to have a $36,487 paid down towards the mortgage, with the average yearly mortgage pay down of $7,297. Now appreciation, I put in an estimated 4%, which is pretty modest. So with Calgary, I do want to keep this lower just because the market isn't like here in Ontario, where, you know, last couple of years we've seen 30 to 40%, which is absolutely insane. So I did want to keep this a modest 4%, which is turns out to be an annual appreciation of $13,996. That's based off of the first year. So if you go to the total return calculation, we have the mortgage pay down annually of $7,297 with the annual appreciation and the annual cash flow. You add all of those up, and here is your total estimated annual return, which I think is great. It's not very hands-on. It's very hands-off. So I'm happy with that number. Again, this is legals and title insurance estimate here, just kind of going into the total cost of borrowing here. So this is the total investment, $71,480, and the annual return on investment, 35.74%. That is a great number, especially for a new construction home. I'm very happy with that. Obviously, you can get greater returns with other investment strategies, but for something that's hands-off, again, I'm super pumped about that. And that's basically everything in a nutshell there. And like I mentioned before, we actually end up having a positive cash flow, which I am super pumped with. So there you have it, guys. The proof is in the pudding. There are new construction homes out there that do cash flow right off the bat. You just have to think outside the box And for my specific case, I had to think outside of my immediate province. Now, obviously, there is a mental aspect to purchasing a place that you can't physically see in person. I have had to get around that. However, I'm glad I did because I'm very excited for this opportunity. Now, distance investing is not for everyone, and I totally understand why people neglect to go that route. However, I just want to say that there are ways to be as hands-off as possible. One way is to hire a property manager. Property managers essentially take care of that property, they interact with your tenants, and essentially you're giving them a percentage of that monthly rent to them. So that's it for today's video, guys. I hope you enjoyed it. Let me know what you thought in the comment section down below. If this is something that you'd like to see in the future, I can continue doing these types of videos. Also, don't forget to join the VIP club down below in the description. It's essentially a monthly contest that we run where one lucky winner wins a prize. And the more of you guys that join the club, the bigger the prizes get. Thanks again for watching, guys, and I'll see you on the next one.